In this lecture, we will go over the CFA Level 1 reading on derivative markets and instruments. This is an introductory reading. We will talk about the definition of derivatives, the structure of the derivatives markets, and then we will talk about different types of derivatives. This section is quite long, but most of what you will see in this section will be covered in much more detail in subsequent readings. So what I will do is cover the material at a level which will be sufficient for you to answer the questions in the examples in this reading and the questions at the end of this reading. And my advice will be that you come back to this material or come back to the questions after you have done the other readings which are part of the derivatives course. In section 5, we will talk about the purposes and benefits of derivatives. Then we will go over the criticism and misuses of derivatives. And finally, we will cover the elementary principles of derivative pricing. Here is the basic definition. A derivative is a financial instrument which derives its value from an underlying asset. And I have asset here in parentheses because sometimes the underlying might not be an asset. The underlying might be an interest rate. The curriculum goes into a lot of detail related to this definition, but I feel that at this stage, as long as you know this basic definition, you are in good shape. But it is important to understand a few important points. The derivative is a legal contract. It is a piece of paper, an agreement or a contract, which is based on something else. That something else is called the underlying. And this image is good to keep in mind. So the derivative is the contract or the agreement which is based on an underlying asset. We will call the underlying an asset for now because that is easier to think about. A really simple contract is one where two parties, let's say party A and party B, agree that after 6 months, party A will sell a given stock, let's say stock XYZ, to B. This is a contract. The sale or the transaction is not happening now. The two parties are agreeing to conduct this transaction after 6 months. The underlying in this example is the stock XYZ. The two parties involved are A and B, and note that at this stage, all they are doing is signing a contract or coming to an agreement. This contract is a derivative. The value of this contract or the performance of this contract will depend on the underlying. And to make this more concrete, let's say that this agreement is that A will sell the stock to B for $50. That will also be written in the contract. Now, what is the value of this contract over time, and specifically what is the value of this contract after 6 months? Clearly, the value depends on how this underlying stock performs. If the underlying stock does extremely well and goes up in value to say $75, then clearly this contract is valuable for party B, which is buying the underlying asset for 50. So notice that the value of the contract or the performance of the contract is based on the performance of the underlying asset. The terminology that is used for these two parties is long and short. The long is the party that is going to buy the underlying asset, and the short is the party which is going to sell the underlying asset. There are many types of derivatives that we will be talking about later in this lecture as well as in subsequent readings. Another important term to learn here is risk management. The reason we need to learn this is because one of the primary use of derivatives is to manage risk. Risk management is the process by which an organization or individual defines the level of risk it wishes to take, measures the level of risk it is taking, and adjusts the latter to equal the former. This is a slightly complicated definition, but what it is saying is fairly simple. Organizations take on different kinds of risk, and when organizations recognize that risk and take actions to control or manage that risk, then the process that they go through is called risk management. And the link here is that derivatives can be used to manage risk. If you think about the example that I just gave you, we have a given stock such as XYZ which will perform in a certain way. A derivative which is based on XYZ could be used to manage the risk associated with this stock. And as you understand derivatives over the next few lectures, you will get a sense for how various types of derivative instruments can be used to manage risk. Now let's go over some questions in the curriculum, and these questions are presented in example 1 in the curriculum. Which of the following is the best example of a derivative? A global equity mutual fund, a non-callable government bond, a contract to purchase Apple computer at a fixed price. The correct answer here is C, because this is a contract. Two parties are signing a contract to execute a transaction at a fixed price, probably at some point in the future. Let's see if you can answer this question now. Which of the following is not a characteristic of a derivative? And underlying, this is a characteristic, we just talked about it, so that's not the right answer. Low degree of leverage, let's put a question mark here for now. Two parties, a buyer and a seller. We've already talked about this. This is a characteristic and therefore not the right answer. The correct answer then is low degree of leverage. This is not a characteristic of a derivative. Try this now. Again, the question is asking for which statement is not true. They are created in the spot market. They are used in the practice of risk management. We've just talked about the fact that this is a major use of derivatives. So that is a true statement and therefore not the right answer. They take their values from the value of something else. This is also a true statement and therefore not the correct answer. The correct answer is A. Derivatives are not created in the spot market. Section 3. The structure of derivative markets. Broadly speaking, we have two categories: exchange-traded derivative markets and over-the-counter derivatives markets. Futures contracts are traded on exchanges, and we will see this material in a lot of detail when we do the reading on futures contracts. But at a high level, here is what you need to recognize. With exchange traded markets, we have an exchange in the middle. A classic example of an exchange would be the CME or the Chicago Mercantile Exchange, and futures contracts trade on this exchange. What the exchange does is it defines standardized contracts where everything is standardized except the price. As an example, the exchange might define a standardized contract for gold. Here it will be defined that this is the quality of gold, this is the quantity, here is where the gold will be delivered, and so on. The only thing not defined will be the price. The price is determined in the market by the buyers and the sellers, or we can say the long and the short parties. Then the long and short parties interact with each other through the exchange. We will have a long party which will deal with the exchange and a short party which will also deal with the exchange. The exchange is responsible for what is called the clearing and settlement process. Clearing refers to the process by which the exchange verifies the execution of a transaction and records the participants' identities. Settlement refers to the process whereby the exchange transfers money from one participant to the other. That is all I'll say at this stage related to this point, and as I mentioned before, we will see this material in more detail when we do futures. All contract terms are standardized except for price. We've already talked about this. Because the contracts are standardized, that makes them more liquid relative to the over-the-counter market. Also, these transactions are more transparent. The price, for example, is published. The contracts are standardized. So these transactions and these markets are more transparent relative to the over-the-counter markets. The exchange also helps ensure that there is no credit risk. And as we'll see in the reading on futures contracts, any party that wants to engage in transactions over here needs to post a margin, or what is also called a performance bond, which helps ensure that there is no default. The other attribute of exchanges is that generally there is a daily mark-to-market or daily settlement. Any party that is winning because the price of the underlying changes, that party is compensated at the end of the day, and the party that might be losing will have to make a payment at the end of the day. And this again is material that we will see in more detail later. At this stage, you need to recognize that credit risk is effectively eliminated when we do transactions through an exchange. The other type of market is the over-the-counter market. This is an informal network of market participants. This is also called a dealer market because we have a network of dealers. So these market participants are the dealers who network with each other and buy and sell either with each other, or they might also interact with what's called end users. These might be corporations that need to hedge their risk. The derivatives in this market tend to be less liquid compared to derivatives which are traded on an exchange. These are private transactions between different entities, so these transactions are less transparent compared to exchange traded markets, and the contracts or the agreements are customized. So two parties A and B can agree on any terms that they want. That's why we say that these transactions are customized. We will see this material in more detail when we do forward contracts later in the derivatives segment of the curriculum. The final point I'll make on the slide is that market makers make money or make a profit through what is called the bid-ask spread. What a market maker does is interact with different parties. So if a given party A wants to take a long position, then the market maker will take the opposite position or a short position, and then the market maker will find another party, let's say party B, with whom this market maker will take a long position. In other words, with party A, the market maker is going to take a short position. So the market maker is saying that he will sell, And over here with party B, the market maker is saying that he is taking a long position, which means that he will buy. And these two cancel each other out. So no matter what happens to the underlying, whether the price goes up or down, the market maker is covered. So how does the market maker make money? That would be through what's called the bid-ask spread. The amount at which the dealer or the market maker will buy is called the bid price, and this is going to be lower than the ask price. The ask price is how much the market maker will sell for. The difference between these two numbers is called the bid-ask spread, and generally this is where the market maker makes a profit. Let's go over example 2 from the curriculum now. And I want you to try this before you look at the solution. Which of the following characteristics is not associated with exchange traded derivatives? Margin or performance bonds are required. Remember, these are generally required with exchange traded derivatives. So these are required. The exchange guarantees all payments in the event of default. Again, given that there is no credit risk, that is because the exchange is guaranteeing payments. So this is a characteristic. All terms except the price are customized to the party's individual needs. Now, customization is associated with over-the-counter markets, not with exchange-traded markets. So this is not a characteristic of exchange-traded markets, hence C is the correct answer. Which of the following characteristics is associated with over-the-counter derivatives? Trading occurs in a central location. They are more regulated than the exchange-listed derivatives. They are less transparent than the exchange-listed derivatives. Hopefully you recall from the previous slide that exchange-listed derivatives are less transparent, so this is the correct answer. But through this question you can see another couple of important points. I didn't say this explicitly, but you might imagine that an exchange would have a central location. So the Chicago Mercantile Exchange obviously is based in Chicago. Over-the-counter markets have dealers that could be all over a country, or in a global market they could be all over the world. They are more regulated than exchange-listed derivatives. Actually, exchange-listed derivatives tend to be more regulated and over-the-counter markets are less regulated. Market makers earn a profit in both exchange and over-the-counter derivatives markets by charging a commission on each trade, a combination of commission and markups, buying at one price, selling at a higher price, and hedging any risk. And this is what we talked about. Market makers make money based on the bid-ask spread, and that is what is described over here. So C is the correct answer. Which of the following statements most accurately describes exchange-traded derivatives relative to over-the-counter derivatives? Exchange-traded derivatives are more likely to have greater credit risk. Remember, we said exchange-traded derivatives effectively have no credit risk, so this can't be right. Standardized contract terms, that looks right. Greater risk management uses, this is not necessarily true. Both exchange-traded derivatives and over-the-counter derivatives have risk management uses. So the most accurate statement is B. Section 4, types of derivatives. Here we will talk about the two major types of derivatives, which are forward commitments and contingent claims. We will say a little bit about hybrids, which is a combination of derivatives with other instruments, and then we will talk about derivatives underlyings. Let's start with forward commitments, and we will look at the definition first. Forward commitments are contracts entered into at one point in time that require both parties to engage in a transaction at a later point in time, and that is the expiration, on terms agreed upon at the start. The parties establish the identity and the quantity of the underlying, the manner in which the contract will be executed or settled when it expires, and the fixed price at which the underlying will be exchanged. This fixed price is called the forward price. The definition is long, but the idea is fairly straightforward. Let's say you have two parties, A and B. At time 0, parties A and B sign a contract which says that A will sell stock XYZ and B will buy stock XYZ at the end of 6 months. And this is similar to an example that I gave you earlier. That contract is a forward commitment because at time 0, both A and B are agreeing to do something in the future. Notice that they are agreeing on the underlying. The underlying is one stock of XYZ. The later point here is 6 months. The parties establish the identity and quantity of the underlying. Identity is this stock. Quantity in my example is 1. The manner in which the contract will be executed or settled when it expires. The contract will also say whether the selling party needs to physically deliver this particular item or whether the settlement here will be in cash. And this is something that we'll see in more detail later. The fixed price at which the underlying will be exchanged. This contract also needs to specify the fixed price. If that fixed price is 50, that means that A will sell for 50, B will buy for 50, regardless of what XYZ is worth over here. And again, this price is called a forward price. There are different types of forward commitments, and this is slightly confusing, but one type of a forward commitment is called a forward contract, another is called a futures contract, and a third is a swap. Each one of these has a reading unto itself later in the curriculum. A forward contract is one where the two parties create a customized contract. So two parties agree on the underlying, the quantity, and whatever terms they want to agree on, put those terms in this contract and sign the contract. So it is a customized private contract between two parties. But the major characteristic here is that both parties agree to do something at a later point in time. Futures contracts are similar except that they are exchange traded, so they are standardized. And swaps represent a series of cash flows which are exchanged, and we'll see this in more detail later. Let us now get into the different kinds of forward commitments in more detail. The first one that I just mentioned is a forward contract, and again, don't get confused. Forward commitments is the high-level term. Under forward commitments, we have forward contracts, futures, and swaps. Here we are talking about forward contracts. A forward contract is an over-the-counter derivative contract in which two parties agree that one party, the buyer, will purchase an underlying asset from the other party, the seller, at a later date at a fixed price which they agree on when the contract is signed. And the example that I just gave you applies here. Just to help you memorize this concept, I will show you that picture again. At time 0, two parties A and B sign a contract which says that at the end of month 6, A is going to sell and B is going to buy an underlying asset. So the underlying asset is one stock of XYZ. That underlying is specified over here. The expiration of the contract is specified. The forward price of 50 is specified. And how the contract will be settled is also specified. Those are the key pieces of information that are written in this contract. Obviously, there are other details also, but here is the core information. So this is a forward contract. Again, I want to emphasize some points over here. This is an over-the-counter derivative contract, which means it is between two parties. It is, in essence, private and customized. I have talked about this before, but want to emphasize this terminology, long and short. Let's say that in this contract, A will eventually sell. So A is getting into the contract to sell XYZ and B is getting into the contract to buy. The party that is getting into the contract to sell the underlying is called the short party, and one way to remember this is S for sell and S for short. Party B is getting into the contract to buy. This is the long party, and the silly way of remembering this is the party that is buying has deep pockets or long pockets, and that is the party which will buy. So long buy and short is the party that will sell. Notice that the forward price is set in the contract. No matter what the price of the underlying might be, this forward price is fixed. If the stock price ends up being above 50, so let's say this particular stock XYZ ends up at 60, then who gains? The long party gains. And just remember this, the long always gains if the underlying goes up. Why? Because the long is committing to buy for 50, the short is selling to sell for 50. If the underlying goes up, then the long is getting something that is worth 60 for only 50. So what is the payoff? If we look at different stock prices, the stock XYZ here is the underlying, then at a price of 50, if the stock price ends up at 50 at expiration, then the long does not gain and the short does not lose, because the long is paying 50 for an asset that is worth 50. What if the stock price is 60? Then the payoff or the gain to the long is 10. Why? Because the long will pay 50 for the underlying asset XYZ, and then the long can sell that same asset for 60 in the market, because the market price here is 60. If the market price is 70, then the gain to the long is 20. So notice that the payoff diagram looks like this. What if the stock price ends up at 40? Then the long still has to buy for 50. In the market, the long would sell for 40. So the loss here would be 10. So the payoff diagram is this 45-degree line which passes through 50, 50 being the forward price. What about the payoff for the short party? And I'll do this in a different color. So let's do the short party in blue. The payoff for the short party is going to be exactly the opposite. If the stock price is at 60, then the short party loses. The short party makes a loss of 10 because the short party has to sell for 50 an underlying asset that is worth 60. Notice that the gain to the long is the same as the loss to the short. That's why derivatives are also called a zero-sum game. The gain to one party is equal to the loss to the other party. Futures contracts. Futures contracts also fall under the broader category of forward commitments. Let's look at the definition. A futures contract is a standardized derivative contract created and traded on a futures exchange in which two parties agree that one party, the buyer, will purchase an underlying asset from the other party, the seller, at a later date and at a price agreed on by the two parties when the contract is initiated, and in which there is a daily settling of gains and losses and a credit guarantee by the futures exchange through its clearinghouse. Again, this material will be covered in detail when we do the reading on futures contracts, but I want to emphasize the similarities and differences between futures and forwards, which is what you might be tested on over here. As with forwards, two parties agree at time 0 to conduct a transaction at some point in the future, and the two parties agree on a price. That price is called the futures price, generally denoted by small f. Forward prices are denoted by a capital or an uppercase F. But there are differences. Notice that I underlined standardized. Futures contracts are traded on exchanges, so they are exchange traded, and as we discussed earlier, the contracts are standardized. Everything is standardized except for the price. The price depends on the buyers and sellers. There is an underlying asset, so you might have a futures contract where the underlying is gold, for example. As with forward contracts, the agreement is to do something at a later date. The price agreed is the futures price. This is another important difference. There is a daily settlement of gains and losses. Let's say that you have two parties, A and B. A is the party that is selling, so A is the short party, B is the party that is buying the underlying or getting into the contract to buy, so B is long. If initially the futures price is set at 50 and then the price of gold goes up, who wins? The answer is that the long party benefits. Why? Because the long got into the contract to buy at a certain price. Now the underlying has gone up, so clearly the long benefits. Rather than wait till the end, what happens with futures contracts is that at the end of each trading day, the account of the long party is going to be credited. In other words, the appropriate amount of money will be added to the long party's account, and the party which is losing, the short party, will have a certain amount deducted from their account. When we do futures contracts later, we will go through detailed examples where we look at exactly how much money is added and subtracted at the end of every day. And since we will cover this material in detail later, I will not talk about it over here. The curriculum goes over several details, but I think that since you will cover this in the reading on futures, there is no point doing that same material over here. If you really want, you can do the reading on futures and then come back and read this section from the curriculum. Next we come to swaps, and swaps also fall under the larger category of forward commitments. A swap is an over-the-counter derivative contract in which two parties agree to exchange a series of cash flows whereby one party pays a variable series that will be determined by an underlying asset or rate, and the other party pays either a variable series determined by a different underlying asset or rate or a fixed series. I'll give you a very simple example and then you will see this in more detail in the reading on swaps. The simplest kind of swap is called a plain vanilla interest rate swap. Let's say we have two parties, A and B. If these two parties agree that A is going to pay a fixed rate of, let's say, 10%, and B is going to pay a variable rate. Let's say that the variable rate is KIBOR, which is the Karachi Interbank Offer Rate. This is an example of a swap, but obviously more information needs to be specified. We need to specify the notional principal, which is the amount on which the actual interest payment will be calculated. If the notional principal is 100 million, this means that party B will pay a fixed rate of 10% of 100 million and party B will pay based on KIBOR. Obviously, in this particular swap, we also need to specify when payments must be made and how long the swap is in effect for. The total duration of the swap is called the tenor. This might be 3 years. Both parties might agree that payments are made every year. Then we would say that the payment is annual. Both parties could also agree that the payments will be quarterly. That really depends on the two parties. Notice that this is an over-the-counter contract, which means that it is customized per the requirements of A and B. That is all I will say over here because this is material that you will see in more detail later. We'll now go over questions from example 3 in the curriculum. Which of the following characterizes forward contracts and swaps but not futures? They are customized. Remember, both forward contracts and swaps were traded in over-the-counter markets. So they are customized. Futures are traded on exchanges and they are standardized. They are subject to daily price limits. I did not mention this, but this is something that is mentioned in the curriculum and something that you will see in detail later. We have daily price limits associated with futures contracts. Their payoffs are received on a daily basis. This is the daily settlement that I talked about with respect to futures. So the question is asking for the characteristics of forwards and swaps. The correct answer then is A. Which of the following distinguishes forwards from swaps? Forwards are over-the-counter instruments, whereas swaps are exchange-traded. This is not true. We just talked about the fact that swaps are also over-the-counter instruments. Forwards are regulated as futures, whereas swaps are regulated as securities. This makes no sense. Swaps have multiple payments, whereas forwards have only a single payment. This is correct. Remember, with my interest rate swap example, I said that the tenor is 3 years and the settlement was every year, which meant that multiple payments are being made. With a forward contract, only one payment is made at expiration. Next, which of the following occurs in the daily settlement of futures contracts? Initial margin deposits are refunded to the two parties. Gains and losses are reported to other market participants. Losses are charged to one party and gains are credited to the other. I did not cover this over here because you will see this material later, but since this has come up in a curriculum example, I'll just briefly mention a little bit more about futures contracts. With futures contracts, we have the exchange in the middle and two parties, the long and the short, which will interact with each other through the exchange. For a party to enter into a contract, it must post a certain amount of money. That is called the initial margin. So both parties, the long and the short, have to post an initial margin. That is really a initial deposit. You can think of it like a security bond, or you can think of it like a performance bond, so that money is not refunded. Therefore, option A is not correct. Gains and losses are reported to other market participants. That's not true. The gains and losses are known to each party, and if A gains, then A receives money. If B loses, then money is taken out of B's account. So this is not a true statement. Losses are charged to one party and gains credited to the other. This is a true statement. Therefore, C is the correct answer.